Most people think the debt crisis is something happening somewhere else, to someone else, sometime in the future. But what if I told you the debt crisis isn't coming, it's already here, and you're living inside it right now without even noticing? Because debt today doesn't look like panic or collapse. It looks normal. It looks like monthly payments. It looks like subscriptions, mortgages, student loans, credit cards, buy now, pay later plans, and car financing stretching longer than ever before. And that's what makes this different from past crises. The modern debt crisis is quiet, slow, and disguised as convenience. For decades, debt was supposed to be a tool, something you used carefully to build a life, a mortgage to buy a home, a loan to start a business, student debt to build a career. But over time, the system shifted. Debt stopped being a tool and started becoming the default way people survive. Instead of borrowing to get ahead, millions now borrow just to stay afloat. And the reason isn't simply overspending or bad decisions. It's structural. Costs have risen faster than incomes for years, especially housing, healthcare, and education. When prices climb faster than wages, debt fills the gap. It becomes the bridge between what people earn and what life actually costs. The most dangerous part is that modern debt is designed to feel painless. You don't hand over cash anymore. You tap a card, you click a button, you split a payment into 4. Apps show monthly amounts instead of total prices. Companies don't want you thinking about the full cost. They want you thinking about whether you can afford the payment. That psychological shift is huge. Because when people focus on payments instead of price, they consistently agree to spend more than they otherwise would. This is why the monthly payment model has quietly taken over almost every industry. Phones, furniture, cars, streaming, software, even groceries in some cases. Everything is becoming a subscription or installment. And once everything becomes a payment, everything becomes debt. There's also a deeper system at work. Debt isn't just a personal issue. It's economic fuel. Governments run on debt. Corporations run on debt. Markets run on debt. In fact, modern economies are built on the assumption that debt will always keep growing. Countries borrow to stimulate growth. Companies borrow to expand. Consumers borrow to spend. And as long as everyone keeps borrowing, the system keeps moving. But that creates a fragile balance, because growth starts depending on borrowing instead of productivity. And when growth depends on borrowing, the system becomes addicted to it. You can actually see this happening globally. Government debt levels around the world are higher than they've ever been outside of wartime. Corporations have taken on record borrowing because interest rates were low for years. Consumers are carrying record credit card balances in many countries. It's not one sector in trouble. It's all of them rising together. And when debt rises across governments, companies, and households at the same time, the risk isn't just individual defaults. The risk is systemic strain. But here's what makes today's situation especially tricky. The system doesn't collapse the moment debt gets high. It usually holds together longer than people expect. That's because debt crises don't explode suddenly. They tighten slowly. Payments increase. Interest rises. Wages stagnate. Credit becomes harder to access. People cut spending. Businesses slow hiring. Growth weakens. It's less like a crash and more like pressure building in a sealed container. Nothing looks dramatic at first. It just feels harder and harder to breathe financially. Another reason this crisis hides so well is that debt is socially normalized. Everyone has it, so nobody thinks it's unusual. If everyone has a car payment, it feels normal. If everyone has student loans, it feels normal. If everyone carries credit card balances, it feels normal. But something being common doesn't mean it's safe. It just means the risk is shared. And shared risk is often more dangerous because it spreads stress through the entire system at once. Interest rates play a huge role here too. When rates were low, debt felt manageable. Borrowing was cheap. Payments were smaller. People could refinance or roll balances forward. But when rates rise, the math changes instantly. Suddenly, the same debt becomes heavier. Monthly payments jump. Credit card interest compounds faster. Adjustable loans reset higher. And what used to feel affordable starts to feel tight. This is why rising interest rates often expose debt problems that were already there but hidden. There's also a generational angle to this. Younger generations are entering adulthood with higher starting debt than previous generations had. Student loans, rising rents, and higher living costs mean many people begin their financial lives already behind. That doesn't mean they're irresponsible. It means they're starting from a different baseline. And when you start with less margin, every financial shock hits harder. A job loss, a medical bill, or even inflation can push someone from stable to struggling very quickly. But the real danger of a debt-heavy system isn't just financial. It's psychological. Debt changes behavior. People in heavy debt tend to take fewer risks, switch jobs less often, delay starting businesses, postpone families, and avoid big decisions. Debt doesn't just affect wallets. It affects choices. And when millions of people make more cautious decisions at the same time, the entire economy slows down. Consumption drops. Innovation slows. Mobility declines. Debt quietly shapes society's future without most people realizing it. Now, none of this means debt is always bad. Used wisely, it can still be powerful. The issue isn't debt itself. The issue is dependency on debt. When individuals rely on borrowing to function, when companies rely on borrowing to grow, and when governments rely on borrowing to operate, the system becomes sensitive to any disruption. It's like building a tower that stays stable as long as nothing shakes it. But the moment something does, everything starts wobbling at once. So the real question isn't whether there's a debt crisis. The real question is how societies adapt to it. Historically, debt problems resolve in only a few ways. Growth outpaces debt. Inflation erodes it. It gets restructured. Or it defaults. None of those options are painless. Growth takes time. Inflation hurts purchasing power. Restructuring damages trust. Default causes shockwaves. That's why policymakers try to delay debt problems for as long as possible. Because every solution has trade-offs. For individuals, though, the takeaway is surprisingly simple. The people who handle debt best aren't the ones who avoid it completely. They're the ones who understand it clearly. They know the true cost, not just the payment. They know which debt builds flexibility and which debt removes it. And most importantly, they avoid letting debt control their decisions. Because once debt dictates your choices, it stops being a tool and starts being a trap. The modern debt crisis isn't loud. It doesn't come with alarms or headlines every day. It's quiet, gradual, and normalized. But its effects are everywhere, shaping how people live, work, spend, and plan their futures. And the people who understand it early don't panic. They prepare. Because in a system built on borrowing, the biggest advantage isn't having no debt at all. It's knowing exactly how debt works before it starts working against you.